Welcome to the Create More Value podcast, sponsored by FORTUNA Advisors, the boutique shareholder value improvement advisory firm. Create More Value is a series of conversations with senior executives, board members, investors, and other experts that have overcome challenges to create exceptional value for their companies. There are many ways to drive value, so we cover a wide range of topics. I am the host, Greg Milano, founder and CEO of FORTUNA Advisors, and I hope you enjoy the conversation as much as I did. I'd like to welcome my good friend, Paul Clancy. Thank you, Paul, for joining me on our new FORTUNA Advisors podcast, Create More Value. This is episode 1, and you are my first guest, so thank you for that. Paul currently sits on the board of directors at 4 life science companies, including Insight Pharmaceuticals, Exact Sciences, Agios Pharmaceuticals, and Xylo Therapeutics. Prior to that, he was CFO at both Alexion Pharmaceuticals and Biogen, and before moving into biotech, he spent 14 years at PepsiCo. Paul has been recognized in the top 3 of biotech CFOs in the Institutional Investor Annual Survey in all years from 2011 to 2020, and he was awarded the number 5 top CFO spot in the inaugural ranking of best CFOs by the Wall Street Journal across all industries. A very impressive award. One of the things that can happen to companies that don't create enough value is they can attract activist investors into their stock. You've had a good amount of experience with this, so we'll focus on that at least as the core of our conversation, and then we'll go from there.
That sounds great.
Thanks, Paul. So let me just dive right into it. The first question I have, I guess, if I go back to your time at Biogen, Carl Icahn invested in the stock, and he was actually in the stock when we first met. And I guess just tell me a little bit about it. How did it start? What were some of the experiences that you had that might be helpful for others?
Yeah, I'd be glad to. Yeah, I mean, interestingly, I'll just expand a little bit on both Biogen and Alexion to start. I was CFO across those 2 companies. 10 of the years were at Biogen and a couple of years at Alexion, but I think almost every single year I was all involved in shareholder activism, not by design, not by desire or anything like that, but I was appointed CFO on a Monday in August of 2007, and on Tuesday, the security filing came out from Icahn Enterprises that he was in the stock. So it kind of defined my first 3 years of being a CFO, and even actually the whole 10 years at Biogen. Carl at Icahn Enterprises at the time had a basic thesis that large pharmaceutical companies could gobble up, could buy kind of the biotech companies that had emerged and became profitable and were generating lots of revenue to both get a new set of capabilities that some of them didn't have at the time. Today, all of them have kind of biotech capabilities, but at the time, most of those large pharma companies were very focused on what's called chemistry or small molecule type medicines. And biotech had kind of over the prior 20 plus years had created a tremendous capability. So the basic thesis, which probably wasn't wrong, was, these smaller companies in the hands of the great sales and marketing expertise of larger companies was kind of a best owner principle, if you will. And then I'd say the other thing that was the backdrop at Biogen was about 2 years prior to Icahn Enterprises getting involved, we had a pretty big devaluation event. The nature of biotech companies that they're relatively undiversified revenue streams. So one hit or one miss can kind of make big moves in stocks. And we had a medicine that had launched and was taken off the market for safety reasons. We eventually got it back on, but that resulted in a big devaluation, which came along with kind of really unfavorable investor sentiment. So you kind of had this macro industry dynamic coupled with a micro investor sentiment issue. In the meantime, cash flow generation at the company was going along fine, but it wasn't kind of showing up in the stock price. So, which is one of the kind of big things that investor activists look for. It's kind of value investors on steroids, if you will. So that was the backdrop. We subsequently went through 2 proxy fights with Icahn Enterprises. The first one They did not get any board seats. The second one, they got 2 board seats. And then we headed into a third proxy fight, or contest, and we negotiated for 1 seat. So, and then one of the Icon Enterprises people, one of Carl's kind of underlings, if you will, he actually ended up on the board. He subsequently and stayed on the board for another 7 or 8 years, and subsequently created his own investor activism firm. So that was my 10 years, kind of with all 10 years of Biogen.
Mm-hmm.
Alexion was a different situation, but some of a similar type of dynamics and some learnings that go along with it. And I actually joined Alexion a little bit that they kind of needed my background on knowing how to work with activists, shareholders, which is a special kind of skill in art or craft, if you will. But Alexion had made a very poor acquisition a couple of years before I joined. It was a $30 or $40 billion market cap company and made an $8 billion acquisition that resulted in a fraction of that value being created. And they had some accounting irregularities. They had some management turnover at the top. Investor sentiment was kind of really set back. And Elliott Management, kind of before I joined, was actually in discussions and in conversations and looking at Alexion as an investment.
Alexion's a very different company, right? Because they focus on conditions or diseases that don't affect that many people. They're treatments for these very small, sort of populations that have a condition, which means the volume is low and the price winds up being very high for some of these treatments. That's probably the lack of sort of scalability and so forth is probably something that I would guess people outside the industry have trouble grappling with when they benchmark you against the others that are trying to treat diseases that are more widespread. Was that an issue there that was unique to Alexion?
I don't think it. I mean, that absolutely does characterize Alexion. I don't think it's that unique in the industry. If you go back 20 or 30 years ago, it was very unique. Genzyme was one of the only companies that was pursuing this type of strategy. If you look at the time that I joined Alexion, which was 2017, many companies had gone into what is called orphan diseases or rare disease franchises. Alexion was purely focused on that. But I would say almost all of the large pharmaceutical companies and many of the big biotech companies have some parts of their portfolio that have rare diseases. So, and part of that is just like you can take treatments that start in one disease area and extend them to other indications and other disease areas. But I don't think it was that unique at the Alexion.
Okay. All right. Okay. I work mostly with corporate executives, and many of them speak badly about activists, especially those that have never had one. To be honest, it's funny, but you've had more experience than most, so I guess how would you characterize working with them? Is it constructive? Does it become more professional? Because sometimes, while a proxy fight is going on, or in the early stages of any kind of a activist intervention, you wind up with a lot of, back and forth that, almost like kids in the schoolyard yelling at each other. How does that change, hopefully for the better, and what's your overall view, I guess, of the role that activists play?
Yeah, I actually don't share that view. I actually feel I think, first of all, I think it's situation specific, much like anything in life, it's situation specific. And I think that many activists are actually helpful. So I've never had a view that it's good or bad, or I think it's just part of corporate America. CFOs, CEOs actually should understand it better. I happen to just have lived it for such a long period of time. I think a lot of what is done, and even some of the language we used, right? We're here in the week where Disney just went through kind of their proxy situation with Nelson Peltz. In the language you use, I've even said it, proxy battle, a contest, right? And like you hire lawyers and investment bankers when this all happens, and we talk about defense planning. I think a lot of that is probably bad jargon to be used, despite we and I included use it. much of what the media picks up on, and even to some extent activists sometimes use to their advantage, is what I would call theater. I mean, it literally is simply, some aspect of theater to effectively garner sentiment from institutional investors or garner votes, right? I mean, you even saw theater that was taken to a really extreme with the Disney situation this week from the company, from Disney itself, right? Effectively deploying some of the tactics that are typically used by activism in terms of the level of aggressiveness. And Disney won, right? I mean, I suspect they did that simply because the math suggested that the retail vote was going to matter more than other times. But I suspect, quite frankly, Peltz may come back in a year, right? Who knows? But I also suspect that the conversations between, Disney and Peltz becomes much more professional within 30 days. So my view, it's situation specific. I think it's a fact of life. I think corporate executives, to some extent, should be a little bit more their starting point as opposed to the jargon. Executives have moved the cheese on employees for their whole career, right? All this is an investor moving the cheese on executives a little bit. And I think getting to a more mature dialogue, which in my experience, both with Icon as well as Elliott, as well as Sarissa Capital, it ended up being, it always was very much a mature dialogue, despite the theater kind of that surrounds it.
So if I go back to your experiences, can you identify any specific good actions the company wound up taking that they weren't planning to take, or at least didn't have the sense of urgency to take, that the activists helped promote, where you could say, well, we did this that we might not have done had they not been there?
Yeah, I think on the Alexion situation, I think the blueprint that Alexion came, and they all generally come with a blueprint, right? I mean, the level of work that an activist investment firm does on every single given company that they end up looking at, and then going, more into in terms of an investment, is very deep, right? And I don't want to make it sound like other institutions don't do a lot of work, but certainly they do a lot of work. It oftentimes is presented to management in a 60-page PowerPoint presentation. Sometimes that's shared with the whole investment community as well. I would say at Alexion that there was probably 90% alignment between the activist blueprint of what to do and what we were thinking. And Alexion was a unique situation where kind of almost the whole new management team was new. So we all had a fresh set of eyes looking at this business. There was probably one exception, and we talked about it. I mean, they were ready to kind of bring down R&D levels a lot more than we thought it should happen. We felt you needed still reinvestment to grow the business over the longer term. In fact, that was a good constructive conversation that we ended up getting pretty aligned on. I think on the Biogen side, we had been thinking about corporate portfolio moves for a number of years, like what parts of the business should we be thinking about a divestment or spin. I'd say that was a positive that from the activists, the investor, that they kind of pushed us towards making that move. And it ended up being, some pretty meaningful shareholder value creation as a result of that.
Yeah, that's really what I expect, because I have the same experience in my consulting. We have companies that we go into, and our work creates a bit of sense of urgency around creating shareholder value, that causes them to take things that were just on the drawing board, meetings to discuss, but never any action, and suddenly give them, it's almost like a catalyst for a sense of urgency. Obviously, the activists can do that in a much stronger way.
Yeah, I mean, to some extent, activists push towards taking options off the table. And sometimes management teams want to continue to have optionality, which, to some extent, you may say, oh, and an observer may say that like, oh gosh, that's status quo bias. But maybe there's some truth to that. But there's also some action, some ability to say, we're not exactly sure how, in particularly on drug development, you're not exactly sure how everything's going to play out because it's not always linear. You like to oftentimes have optionality, right? And I mean, the definition of strategy is deciding what to do, but also what not to do, right? So to some extent, there's an acceleration of making decisions on things that sometimes management teams, are looking to have continue not to make a decision in kind of the positive angle of optionality. Yeah.
That's a really interesting way to describe it. Often what I say is that companies in their allocation of capital and innovation money and marketing money, they like to spread a little bit everywhere, right? Because they're not totally sure what's going to work. And so this way they kind of sort of maximize the possibility that they're going to hit some of the most important things. And I would say the work we do with clients and also what activists try to do is to get you to figure out, of those 10 things you could be doing, what are the 2 or 3 that are really most important? You really concentrate your resources. Much like Warren Buffett buys a concentrated portfolio of stocks, he should be doing the same thing inside a company. You even have better information for doing it than he has. So if I now turn it around and say, okay, if some people listening to this are executives or board members of companies where they might have a concern about an activist coming in, what would you say are some of the things they should do to try to keep activists looking elsewhere? What are the things to look for in their company that might attract activists, and what can they do to change the status quo to reduce that attraction?
Yeah. Well, Greg, you have a fabulous article I think it's called Be Your Own Activist, or that's the theme of it in any event. But I think it's a fabulous, fabulous article.
Thank you.
But I would say that and I use it in teaching to students nowadays, but I would say, I completely agree with that. But I'd frame it as most of what we should be doing follow the principles of business or the principles of applied corporate finance. In the blueprint, to some extent, that activists use, and they'll get industries in companies specific, but that blueprint is very similar to what we learn in business schools in applied corporate finance. And interestingly, when we talk about this subject matter, we put it into the category of investor management. And what we should be doing is probably 90% non-investor management and 10% investor management, right? I mean, but this conversation pulls us into the exact opposite. But 90%, and what I mean by that is 90% kind of applied corporate finance of non-investor management is making sure you get the right strategy and the right decisions on that strategy of where to play and where not to play. I think the whole topic of capital allocation becomes incredibly important. And certainly the industry that I've been in, which is you could characterize it as high margin and high growth. The premium on capital allocation is even more. So, and that's really true of where the economy has moved with respect to tech and life sciences, et cetera. But being smart about acquisitions, not a bad acquisition is going to be a lightning rod and a screening criteria for activists to look at it. So being good about your M&A strategy, making sure you're not overpaying and you get the right M&A strategy, returning capital to shareholders when you don't have anything left to do, and doing that in a thoughtful way, being really aggressive about resource allocation is exactly what you kind of referred to before but inside of a company, like determining who gets the money, division wise, line of business wise, brand product wise, geographic wise, is a really important kind of distinction that often gets smeared inside companies, right? And everybody gets the dormant capital resource allocator. Everybody gets plus 3% in their budget next year. And there's forces inside companies that kind of make that happen, right? That's how we're organized inside companies. But a good CFO, a good corporate finance organization is bucking that trend, figuring out where the big ROIC pockets of the business are and overfunding those and
Yeah.
bringing down waste and efficiency and underfunding the places where there's low ROIC. So I think that having good, strong controls and accounting is important as well. And that doesn't sound sexy,
Mm-hmm.
but my experience at Alexion was, in fact, a significant deficiency and a material weakness actually kind of really impacts investor sentiment.
Mm-hmm.
There are firms that don't and can't invest in companies like that. So you want to make sure you never get yourself into, and then you get to kind of the 10%, which,
Mm-hmm.
the investor management, which is, being ahead of the conversations and listening to the right investors and educating. It's not about hype per
Mm-hmm.
se, but certainly it's about educating. So, and this is all before, right?
Mm-hmm.
I mean, clearly, if you get yourself into the 90-10 rule doesn't quite apply,
Mm-hmm.
right? If you're getting yourself into kind of a, heading into an annual meeting, you're going to end up spending a lot more time on investor management than otherwise. But I'd say it's the really hardcore principles of applied corporate finance, but pushing them harder and harder and harder than you ever think about it.
Yeah, I mean, I think it's one of the big problems is people are unwilling to sort of cut their losses and move on, and especially in development, in drug development, you know, there's so many uncertainties. It's just so easy to say, well, maybe it'll still work, when you really know it's not. We worked with one company in the industry that. When we analyzed their portfolio of R&D projects, over a third of the money they were spending was going toward projects that if you did a life cycle NPV with their forecast, not our forecast, with their forecast, but you went back to when you started spending on that project, it had negative NPV, over a third of the spending.
Yeah.
And some of that, at this point going forward, forgetting about sunk costs, maybe does still make sense to fund, but I think it was a sign that there are a lot of projects that they really should cut, especially if you did more realistic forecasts on them, that they were just hesitant to do. And that's just wasting resources that could be focused on things that, you might be able to get to market sooner or increase the chances of success.
Interestingly, I think the sales and marketing spending inside companies is, to me, even in biotech and life science companies, is even more pronounced.
Mm-hmm.
How smearing of, there are parts of the world and geographies that are just not as profitable as other parts, and they shouldn't be funded to the same level. And same thing with, the nature of biopharmaceutical companies is you have different medicines across different parts of the life cycle.
Mm-hmm.
And the result of that is you should have differing levels of investments that aren't based per se on that sales level for that given year, but more based on what's the potential DCF and NPV
Mm-hmm.
creation of a brand over the remaining time.
That's a really interesting point, because a lot of times when we speak about life sciences, people in the industry say that they have concerns about certain types of performance-based management and so forth, because the biggest things that drive the share price are is the development of new treatments, and that's such a long cycle that annual performance measures really don't don't help, and I completely agree with that. I think you have to use thoughtful financial analysis at times, but it doesn't take as prominent a role as it does in, say, a typical industrial company or consumer products company.
Yeah.
But once a drug or a treatment is available and it's commercially spread around the world and marketed and produced, and at that point it's just like any other commercial business. And so your comment about that weakness in the sharpness of the allocation of resources for marketing, for things that are already in the market, actually, that's a really interesting point.
Yeah, and the other reason I underscore that is your point on the NPV calculation of early stage projects.
Mm-hmm.
There's a lot of wide scenarios around that. We all know all forecasts are wrong, but some are
Mm-hmm.
useful. But
Mm-hmm.
when you get a medicine to market, you actually can narrow the range of outcomes, and you can get a much better handle on things.
Yeah.
So the typical financial tools that we use can be more applied.
Yep, I agree. Yeah, that's good. I have one more question for you, and it goes back to something that I hear from people that speak disparagingly about activist investors. They like to say that they're very short-term focused. Now, in reality, most of them that I know tend to stay in stocks much longer than other investors. So
Yeah.
they have a longer time horizon, maybe not as long as you need to in life sciences. But I guess in either situation that you were in, or any of the three situations, I guess, that you were in, did you ever feel like they were too short term in terms of wanting to slash and burn on R&D spending or anything like that? Or,
No,
was there any element of that you'd point to?
no, I don't. I couldn't point to that. I referenced the kind of brief conversation with Elliot, but we moved through that one very, very quick. So you certainly couldn't pin it on that at all.
Mm-hmm.
I think this part of the financial ecosystem has gotten way more sophisticated, appropriately,
Mm-hmm.
than the kind of old adage that they're short-term focused. I
Mm-hmm.
think it's gotten way more sophisticated. And by the way, and you're right, they probably have a longer holding period. They have certainly a longer holding period than a typical hedge fund.
Mm-hmm.
They probably have a longer holding period than institutional investors. But we shouldn't kind of mix holding periods with people's time horizon,
Mm-hmm.
right? I mean, we know that from the stock market.
Yeah.
Despite these holding periods, what's built into a company's NPV, what's built into their stock price, is huge amounts of terminal value. Right?
Right.
I mean, like if you do a 5-year model, if you even do a 10-year model, right, there's still huge amounts of terminal value. So implied in that, everyone's thinking about kind of what's the ongoing value past their own holding time period. So I don't think that that's the
Mm-hmm.
case.
Mm-hmm.
And I think all investors have gotten smarter about making wise investments. And by the way, I work in an industry where that certain players in the industry will spend high levels of R&D, but it's not fruitful.
Mm-hmm.
And others kind of vice versa. So people are looking smartly at, and will give you leniency and credit towards investments for the long term, as long as they're good investments,
Mm-hmm.
which goes back to our principles of corporate finance, right?
Right.
I mean,
Right.
it doesn't matter, what it means for the P&L for the, next quarter, the next year. And I also don't, I think, kind of this quarterly focus is way more about, like, if a management team says they're going to do something, they should be able to do something.
Right.
As opposed to like hitting or missing and stuff like that. Yeah.
Yeah. Yeah. Well, that's really good. I think that's maybe a good point to end on. I really appreciate you joining me today. I think
Well,
this has been a great discussion, and great to see you again, Paul.
likewise. Thanks for the time.
You have been listening to Create More Value, sponsored by Fortuna Advisors, and I am your host, Greg Milano, founder and CEO of Fortuna Advisors. I hope you have enjoyed this episode. Fortuna Advisors helps companies with strategy, capital deployment, business management, corporate culture, and incentive compensation, all aimed at driving top quartile total shareholder return and the equivalent for private companies. To learn more, contact us at info@fortuna-advisors.com.